Hello everyone. In this video I'm going to continue my discussion about the inventory cost flow methods, and we're just going to see some examples of FIFO, LIFO, and the weighted average methods. And again, this slide here summarizes the discussion that we had in the previous video, where we apply the FIFO method, the LIFO method, and the weighted average. And we'll see it for the three transactional purchase transactions that we had for our inventory. Remember, we purchased one item at $9, another item at $13, and then the third item at $14. So if we're using FIFO, the cost of goods sold would be based on the first item that we purchased. So first in, first out. So the first item that we purchased is the first item to leave. And that's the one that we had on May 10th. So that's why we calculated our cost of goods sold based on $9. And that gave us a gross profit of $11. So our inventory would be the remaining two items here, which is the $13 and the $14 items. And that would leave the ending inventory to be $27, and that would appear on the balance sheet. If we're using LIFO, then we use the last item purchased to be the first item to leave our warehouse. So LIFO, last in, first out. In this case, our cost of goods sold would be this green transaction, May 24th, for $14. And you can see that our gross profit would be lower, which is the difference between sales, or sales minus cost of goods sold would give us gross profit of $6. Then the balance sheet would show the inventory for the remaining two items, which is the $9 item and the $13 item, for a total of $22. In the weighted average costing method, we just add these three items and we divide them by 3. So 9 plus 13 plus 14, that's 36 divided by 3. And that would be $12. So the average cost of the items that we sold, so it was only one item, is $12. And that would make the gross profit to be $8. And as you can see here, the remaining inventory items, which would appear on our balance sheet, it's $12, which is the average, multiplied by 2 units, and that would be 24. So again, this is what we've been covering in the previous video. So let's see this example here. So here we're talking about inventory costing method under the Perpetual inventory system. And for purpose of illustration, the data for item 127B, which is a code for one of the items in the warehouse, are used, as shown below. We'll examine the Perpetual inventory system first. So this is the only time we're going to use the periodic to see how it looks like, and that would be in a later discussion. But right now we're focusing on the Perpetual system. So we have the beginning inventory that we started with 1,000 units at $20 cost. Then we made a sale of $30 per unit, and we sold 700 units. Then we made a purchase of 500 units, then a couple of sales. And again, the selling price is fixed. It seems like we always sell our items for $30. Then we purchased 600 units at a higher cost, $23.30. So you can see that we had a balance of 20, we purchased at $22.40, and then we purchased again at $23.30. So the cost kept going up. However, our selling price, we decided to keep it the same, which is $30. So the problem here is that we want to calculate our cost of goods sold on our ending inventory. You can see that we started with 1,000, then we sold 700, and that would leave us by $300, or 300 units, I mean. Then we purchased 500, so that would make us adding 500 to the 300 for a balance of 800. And then we sold 360 and 240 for a total of 600. So out of the 800, we sold 600, so that would leave us with 200. And then we purchased another 600, so that took the balance again to 800. So when the FIFO method is used in a perpetual inventory system, costs are included in the cost of goods sold in the order in which they are purchased. This is often the same as the physical flow of the goods. Because typically businesses would buy items and then they want to sell the items that they purchased first. They don't want to keep their older items in their warehouse because typically they would go bad or expire. So in most scenarios, businesses would like to sell the older items first before selling the newer items. So for example, grocery stores, shelf milk and other perishable products by expiration dates. Products with early expiration dates are stocked in the front. In this way, the oldest products or the earliest purchases are sold first. This is typically what businesses would do. So let's see this table. We'll need to construct a table like that. So in this table you can see here we have a column for the date, a column or a major column for purchases, a major column for cost of goods sold, and then a major column for inventory. And then all of these three major columns are divided into quantity, unit cost, and total cost. And you see it's repeated again. Quantity, unit cost, total cost, and so on. So if we start by looking at January 1st, we record January 1st, and we bring our beginning balance. So we have 1,000 units. Each unit is worth $20 for a total cost of $20,000. And then the first transaction was a sales transaction. So we record January 4th, and then we move to the column that's related to the cost of goods sold, this main column. And then we record our sales, which is $700 at $20, and that would make a total cost of $14,000. This would reduce our inventory balance from 1,000 to 300. So we take the 1,000 minus the 700 that we sold, and that would bring our balance to 300. So 300 multiplied by 20, and that's $6,000. So remember why we only had one balance here. So when we calculated the cost, we brought these 700 units out of the 1,000. So that's why we didn't really needed to think too much. Then on January 10th, we purchased 500 units at $22.40. And if we multiply these together, that would be 11,200. Our balance now consists of two batches of inventory. We have the remaining 300, so we give it like a separate row here, $320 for a total of 6,000. And then we add to it the most recent purchase transaction, which is the 500 at $22.40, 11,200, and that will be the second row. So you notice here on January 10th, after the purchase transaction, we have to add for the inventory balance a new row. So we have a row for the original balance, which is the 300 units at 20, and we have the new 500 at 22.40. On the 22nd, we sold 360 units. Now keep in mind, we're using first in, first out. So first in, first out, the first units purchased are the first units to be sold. We sold 360 units. The problem, we don't have a quantity that will cover the 300. So we take 300 out of the 300, and then out of the 500, we take the remaining 60. So that would leave the balance of 440, and this entire batch is going to disappear. So for the cost of goods sold calculation, we took 300, which is these 300s here. We multiplied by 20 because that was the original cost, and that would give us $6,000. But remember, we sold 360, so we need to take another 60 from the newer batch, from the 500 units. So 60 at 22.40, and that would be 13.44. So this batch is gone. We are left with the 500, but we took 60 out of it, so we were left with 440. Add the 22.40 cents, and that would be a total of 98.56. On the 28th, we had another sales transaction for 240 units. So 240 units, we only have one batch of 440, so we're going to take 240 out of the 440, and that remaining would be 200. Remember, the cost is the newer cost, which is the 22.40. So 2040 multiplied by 22.40, that would be 53.76, and the remaining balance would be 200 at 22.40 for a total of 44.80. The last thing, on the 30th, we purchased another 600 units at 23.30 for a total of 39.80. So that would be added to the previous batch, which is, so we still have the 200 left from the previous transaction, plus 600, which are the ones that we just purchased. So 222.40 and 600 at 23.30. So that would be 44.80 and 13.98. The last thing, on January 31st, we need to calculate the balance. And this is a little bit tricky. So to calculate the balance of the cost of goods sold, we have to add the entire column for the month. So we have the 14,000 plus the 6,000 plus the 13.44, 53.76, and that would give us a total of 26,720. For the ending inventory 31st balance, you only look at the last inventory balance, which is the 4,480 and the 13,980. If it's only one number, we just take the number as is. But here it happened to be two values on the last transaction, after the last transaction. So we add them together and we got the 8,460. So remember, for the cost of goods sold, we add the entire column. For the inventory balance, we just add the last balance after the last transaction. Okay? So now let's see the last in, first out. When the last in, first out method is used in a perpetual inventory system, the cost of the units sold is the cost of the most recent purchases. The LIFO method was originally used in those rare cases where the units sold were taken from the most recent purchases or purchased units. However, for tax purposes, LIFO is now widely used even when it doesn't represent the physical flow of units. And we'll see why in some future slides, why people sometimes like to use LIFO. So let's try to apply the same concept. And you see here that it's almost going to be the same for the first two or three lines, but afterwards it might change a little bit. So on January 1st, we brought our balance. We have $1,000 at $20 for a total of $20,000. Then on January 4th, we had this kind of sale transaction of $700 at $20, and we got this 20 from this 20 here. So this is the only batch that we had, so we sold 700 out of 1,000. So 700 multiplied by 20, that's 14,000. And the remaining balance is 300 units at $20 for a total of $6,000. Then on January 10th, we purchased 500 units at $22.40 for a total of $11,200. So we add this new batch to the previous batch that we had, which is the 300 plus the 500. However, each one of them has different cost, so that's why we have them in two different rows. So 320 and 522.40, multiply them together, that's 6,000 and 11,200. Again, make sure that you split the cell into two rows, okay? Then on January 22nd, we sold 360 units at 360 units. Now we need to think, which method are we using, FIFO or LIFO? Since we're using LIFO, we're going to start from the latest batch that we purchased. And in this case, it's the 500 units. Is it enough to cover the 300 units? Yes, it's enough. It's actually enough, and then we'll have 140 remaining, and the original batch will stay as is. So we take 360, and the cost assumed is going to be the latest cost, which is $22.40, because we're using the last in, first out. So 360 multiplied by $22.40, and that would be $8,064. So if we took 360 out of the 500, the remaining is 140. So 140 at 22.40, and that total is 31.36. And then the original batch stays as is. The 300 multiplied by 20 for a total of 6,000. Then on the 28th, we sold 240 units. Does the last batch, or the latest batch, have enough to cover the 240? No, it's only 140. So we'll have to use the entire 140 at 22.40, and then we're going to take 100 from the older batch. So 140 at 22.40, and now this is gone. It's not there anymore. This line is gone. And then 100 out of the 300, and that would leave us with 200 units. So 140 at 22.40 and 100 at 20, and we get their totals. And then the remaining balance is 200, which is the 300 minus the 100 at $20 for a total of 4,000. So on the 30th, we made another purchase transaction of 600 units at $23.30 for a total of $13,980. So now we end up having two batches in our ending balance. 200 at 20, which is the original $20 that we have here. But so these are the remaining 200 units out of the original 1,000. Because remember, we sold 300 and then we sold some more. So the only thing that's left now is the 200. I mean, we had 1,000, we sold 700, and then we sold another 200 here. So that left us with, or we sold another 100, so that left us with the 200 here. So 220 at 600 is the latest batch for 23.30, and that would leave us with these two totals, 4,000 and 13,980. So the total for this, for the cost of goods sold, would be the total for that column, the 14 plus the 8,000 plus the 3,136 and the 2,000 for a total of 27,200. And then the total for the inventory balance would be the last batch here. Again, I just want to clarify that. So the remaining 200 are coming from the original 1,000. This original 1,000, we sold 700 from it. So that left us with 300. And then remember, we sold another 100 here. So left us with 200. So 1,000 minus 700 minus 100 left us with the 200 at the $20. And the 600 is the newest batch that we have here. So I'll stop here in this video, and then in the next video, we're going to see the weighted average.